Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Ash Bennington. Today, I have the pleasure of speaking to Diego Parrilla, author of The Anti-Bubbles and The Energy World is Flat. But before we get started, don't forget, tickets for our upcoming in-person crypto gathering in Miami are now up for sale. Head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. Diego, welcome to Real Vision. Always a pleasure to have you with us.
Thank you for having me, Ash.
Diego, you're always one of our fan favorites. You have such a big, comprehensive view of the world. It's always a pleasure to have you with us to map it out. 50,000-foot view. Where do you think we are right now?
Well, let's take that view for a second, and maybe some of the viewers might have, since I've been in Real Vision for almost 10 years now. But let me work through this from the anti-bubble perspective. And generally, the idea is that there's no magic formulas. You can't just, when there's a problem, you can't just pretend that you can print and borrow your way out. And as a result, I think the monetary and fiscal abuse that we're seeing is not really solving the problems. What it's doing is doing four things. And we can go in more detail as I think what's happening really applies to all of those dimensions. But the first thing that happens when you are literally just trying to print and borrow your way out is you are not solving the problem, you're delaying or kicking the can down the road. So you're basically spending and borrowing your way out, and it becomes a bit of an intergenerational issue as you're pushing things out.
Hey, I hope you're enjoying the episode. If you want to dive deeper and really dig into what's going on and how to understand it, then grab my Everything Code PDF for free. Just hit the link in the description below. You're going to love it. I'm sure it's going to really help you.
The second thing that we're doing is we are transferring the problem. So things like monetary policies without limits, or in some ways, they're going to create currency wars that can create, other types of dynamics that effectively look to print and devalue and transfer. And we're seeing effectively this dynamic, which has been driving global market for a long time, leading now to trade wars, with things like effectively trying to have more protectionism, try to increase barriers, try to effectively bring things inwards. Again, these currency or trade wars are not really solving the problems. They're just transferring them around. The third thing that's happening is we're transforming the problem. And you don't have to be a genius to realize that if you're printing literally trillions and trillions of dollars and euros and yen and yuan, effectively there's a natural increase in inflation, which is 100% driven by these monetary drivers, and that is needed to be able to finance the game. And so I think in that transformation, we're seeing big changes. We're seeing fixed income becoming a less reliable source of protection. We're seeing inflation eroding, the value of many things, and inflation has pretty nasty second and third order effects. It's leading also to the transformation of the problem into things like inequality, social unrest, or populism, and obviously geopolitics and wars, which I think are here to stay. And lastly, the fourth point is, it's not really a zero-sum game. We have in my view, we're enlarging the problems, and I think this dynamic is creating, addiction and situations where effectively the world is going to need more printing, not less. It's going to need more debt, not less. And so all these bluffs, that we're seeing across central banks in the world, that we can normalize things, are effectively, like a great philosopher Mike Tyson would say, everybody has a plan until the market punches you in the face, I guess. And that's really the crude reality that places like Japan or the UK or Europe or China or other places are facing. So I think from a big picture perspective, the thesis has been reinforced, has not only survived, it's actually become even stronger and more relevant with time. And so I think these dynamics are very much in play today, a combination of kicking the can down the road, transferring, transforming, and enlarging. And that in some ways is leading to wider divergence, which I think is one of the big themes that the market's looking at into the future. And some of those who've abused the system will pay for that. But that's in some ways the backdrop of the big picture of where we are.
Diego, that's so well said. Let me ask you this: as you map out these structural challenges that lurk beneath the surface of these tectonic plates shifting, and as you framed it there at the 50,000 foot level, everything that's going on that could present a challenge, a headwind to the West more broadly, and the U.S. Obviously more specifically. But let me ask you this: as we sit here at S&P 6,075 on my screen. By the way, I should say we're recording on Monday, December 16. I know this is going to air a little bit later, but the broader trend's still very much in place. As we sit here looking at 28% returns year to date in TTM on the S&P 500, how do you think about those two things at the same time, reconcile what's happening beneath the surface with the performance that we're seeing in U.S. equity markets?
Well, I think what is very obvious, linking to my first point, is that it's hard to be short. It's hard to be underweight. It's hard not to be invested. And if you think about it and take a step back and take a 5, 10, 15, 20-year view, it's really hard not to be invested. I mean, it's not just the equity market, it's real estate, is anything, really. And I think that's kind of what we've seen is mommy and daddy, as I call them, central banks and governments. They face this dynamic, where every time there's a problem, and we faced quite a few in the last few years, from that regional U.S. banking crisis that everybody forgot about, all the way through wars and pandemics, and the answer is always the same. And so I think in that sense, the first point I would make is that it's hard not to be invested. Okay, in some ways you could argue, and I think this was one of my tweets a little while ago, I'm so bearish that I'm bullish, in the sense that, yeah, you know what's coming. You know that every time a problem comes, they're going to be effectively doing more of the same. And so those pro-inflation, pro-growth, pro-fiscal are dynamics that are difficult to fight. That doesn't mean that there's no risk or should be just complacently buying into the central bank put. I think it's almost the opposite. And that brings us to the dynamic or the concept of the anti-bubble. I mean, it's ironic that as valuations are, ever increasing, in some ways, the other side of the coin is insurance, portfolio insurance protection becomes extremely cheap as the market plays this anti-bubble dynamic. And so my approach is really to embrace the volatility of the market, is to embrace, if I may say, the stupidity or the complacency of the market in a very unemotional way. I think you have to be long. And there's no question about that. You need ways in which you're just long inflation, right? Long the market. But you also need to complement it with ways in which you add that defense. And you have your football team or your hockey team or basketball or Formula One, whichever sport you like, you need to play offense and defense. But I think there's a key element there, which is the rebalance, and is how you combine these pieces and you take advantage of this to basically create additional sources of return as you monetize. So I think looking into next year, I don't have a crystal ball, unfortunately. I think there are strong forces and imbalances in both directions. We're going through clearly a super cyclical event with a major game changer in the form of AI, which we're all trying to get our heads around and see what it truly means. And we all know it's huge. There's a world before and after, and there's going to be dramatic opportunities and transformations. At the same time, there are going to be excesses and overvaluations, and I think it's going to be quite an eventful year. Lots of people have written off inflation, or geopolitics, or credit issues, or bubbles, or others. So I think in that sense, this is about building teams, portfolios that can perform well in either condition, but with the view that in the medium long term, I think you need to have this long bias. Who's in some ways, to take the other side of the question, where should you not be in pay, or who's paying for this party? And again, if you take a view that is more medium longer term, I think it's cash and fixed income, and to a lesser extent, but also credit. So assets that are effectively short inflation. And what I mean by this is, if you own bonds that in 30 years are going to give you 100 euros or dollars or yuan back, I don't think those $100 are going to buy you a piece of tuna in 30 years, right? So in some ways, this fixed income or cash or other markets, whilst they might look rational and conservative, they may not be if this real dynamic of inflation continues to play out. And I think that touches on another critical point back to the thesis, which is what's inflation, right, versus official inflation, real inflation, or loss of purchase power, and loss of purchase power after taxes. And so you actually think about this game that central banks play, pretending that inflation is under control and creating some somewhat arbitrary numbers with extreme precision of how things are moving to the basis point, where all of us know on our day to day, the real inflation we feel in our pockets is completely different. So using the analogy that I've used in the past, we're all frogs in this monetary broth, where inflation is increasing at significantly faster rate than official inflation. And those frogs that stay in the water, i.e. cash fixed income, are going to get boiled to death. In fact, in that dynamic, I think it's sort of, how this ties it a little bit with respect to global markets. There's a lot of risk, but there are big forces that I think are, over the very long term, will continue to create this inflation pro-growth and dilution of the debt and the cash and fixed income investors. And again, what does that mean to equity markets? It depends. There's a positive initial bias, but ultimately inflation is bad for everything and everyone. So we are, again, the thesis. For those who have dedicated my book, you'll know that I tend to do it by saying, I hope you like it. I hope I'm wrong, because I do feel in some ways like a doctor that is diagnosing this terrible disease. So on the surface, everything's great. We get this wealth effect compounded by crypto and many other things that are making everyone feel quite wealthy. I think the situation is significantly more fragile underneath. And precisely for that fragility, we will get even greater responses down the line, which sort of feeds back into this crazy dynamic that we live through.
Diego, you said that so beautifully, and I think you really hit on something that strikes a chord with people emotionally when you talk about the wealth effects. Wealth effects are all well and good if you own assets. If you own assets and you see the cost of living offset against the gains that you've seen in those assets. It's the holiday season. Everyone's going to experience this probably at least once, where you're going to be at a party and there's going to be a Wall Street guy there or a finance guy there explaining, listen, CPI in November, it's ticked up 0.3%. This isn't that bad. And yet a lived experience that people have of watching the cost of living spiral out of control, for many people in this economy here and around the world, I should say. It's a very painful and difficult experience, which brings me to something you said earlier, this idea of you're so bearish that you're bullish. I think this is probably the secular version of bad news is good news and good news is bad news. Talk a little bit about what that implies for portfolio allocation. We can keep going a little bit deeper into the philosophy of it, but I want to get your view of what that implies. You sort of started to tee this up where you talked about how the €100 or the $100 aren't going to buy a pack of gum in your view in the future. What does that actually imply for structuring a portfolio?
Yeah, thank you for that. Let me add on wealth effect, which I think it's incredibly important here. So what is wealth effect? And the way I define wealth effect is the illusion of wealth, right? It's you think you're wealthy because the mark to market of something you own is gone up. And as a result of it's basically an artificial setup, you know, in we can think of a few areas where we might see assets that are, valued at levels that might not be realistic. Okay, take your choice. I'm not gonna pick on any at this point, but there's quite a few candidates. Now, the problem with wealth effect is that it is a double-edged sword. So on the way up, wealth effect, it's brilliant. It's a virtuous cycle, and you feel richer, and you spend more, and the proceeds that you make trading X or Y, Tesla or crypto or whatever it goes and gets reinvested. You feel really good. You spend more, and you feel really, really wealthy. The danger of wealth effect is that if this thing is artificial, when things actually implode, they create vicious cycles. And those vicious cycles effectively can be extremely destructive because effectively, I've heard this many times. It's like, oh my God, this asset just lost whatever, 100 billion in valuation in minutes. Where did it go? And my answer is, you know where it went? It went where it came from. Thin air. It never existed. So wealth effect never existed. And I think that's something people need to be very, very careful. The fact that something in your account says there's a lot of zeros, it doesn't mean that you can actually monetize that, or if everyone tried to do it. So I think wealth effect is tricky. Now, wealth effect at a small scale is there's a bit of a zero-sum game. Things never really existed. But when this wealth effect becomes bigger, it starts to imply gross misallocations of capital. And I'm talking about wealth effect and bubbles together. That's when things start to get really systemic. And we've seen it several times. And I think that's to tie into your point is I think we're experiencing a lot of that in certain areas. And to the extent that some of those write-offs would be non-events, or to the extent that they really truly start to impact employment and consumption and financial conditions, I think the central banks will come in with more of the same, and governments. And that more of the same is more fiscal, more spending, more debt. And from levels where we're already at, super high levels. I mean, look at the US and going from Trump 1.0 to 2.0, where we are. But then also monetarily, through the effectively interest rate dynamic. And so I think in that sense, if you look at some of the economies or countries that are already way past the point of no return with respect to their level of debt, and that includes Japan for sure, China and others, when you factor in the entire true liabilities, both committed and emitted, this is a situation that is tricky, and why you could be very bearish about the economy and what's coming, but then if you actually measure the reaction of the market or the equity market, yes, we are in some situation where bad news is good news, but that's not natural, and that's not necessarily very healthy, and ultimately creates this addiction of the fact that if you were to step out of certain markets, there would be the immediate abyss. Think about what would happen to JGBs without BOJ buying them, or what happened to the UK with Liz Truss when she tried to do a few things. And so I think you kind of face that underlying situation of artificial settings that in some cases are way past the point of no return, and that they will require more of the same in scale. And that brings us to this idea that you're going to need more printing and more debt, not less. That's probably the base case. And again, I must say, on the other hand, it's pretty remarkable how things have held, and they've held in some ways for this combination of truly game-changing technologies and as well as wealth effect, and some of these things that set the path of where we go. So it's going to be uncertain, it's going to be volatile, but certainly it's not a done deal. And I think it's a more fragile situation in all respects than what you might look at just by looking at the price action.
Yeah, or as Raul might say, more cowbell. More of the above, more of the same. Diego, walk us through a little bit. I know you've done this here on Real Vision before, but walk us through a little bit of the genesis of the anti-bubble framework and talk about how it might apply. We're in this period here, obviously, between the election of President Donald Trump and the inauguration of President Donald Trump. How might some of the ideas in the anti-bubble framework apply to what your expectations are for 2025?
Okay, so just to define the concept first, for those who are not familiar with it, I always like to borrow George Soros' definition of bubble. And he defines bubbles as assets that are artificially expensive based on a misconception. So some belief that is widely held, but it's false. So a situation where the emperor had no clothes. So eventually it's a matter of when, not if, that bubbles collapse. The idea of the anti-bubble is, when I put my engineering hat on, is you generalize the concept. And I said, well, misconceptions can distort reality, but not only through artificially high valuations, which we call bubbles. You could also have artificially low valuations. And the concept of anti-bubble has these three dimensions. The first one is this idea of assets that are grossly artificially cheap. So it's a matter of when, not if, that they will basically implode higher. The second idea is that bubbles and anti-bubbles are like distorted mirror images of each other. They're based on the same misconception. So in terms of catalyst and timing, is the exact same moment that the anti-bubble implodes or explodes, then the anti-bubble implodes higher. And so I called it anti-bubble, a bit like an antivirus or an anti-missile defense mechanism against the bubbles. And the third dimension is this idea of reflexivity, how bubbles and anti-bubbles feed each other. So think about the S&P and the VIX, for example, how artificially low volatility can contribute to artificially high equity prices, both qualitative and quantitatively. So qualitatively is this perception, this complacency, this idea that there's no risk. Quantitatively is strategies like CTAs, trend following, bold target, risk parity, effectively levering up as the market goes up and the trend's strong and volatility is lower. All of which reverse very quickly when volatility explodes and sort of pricks that bubble. So in this framework, I guess with the bubble anti-bubble is, what's the misconception? Tell me the misconception, I'll tell you the bubble and anti-bubble in some ways. And so we are in a situation where, there are many of those. We talked earlier about the misconception that monetary and fiscal policies solve problems. The answer is no, they don't solve problems. They delay, transfer, transform, and enlarge them. But when you think about other dynamics, such as AI, it's much less obvious, where you are, in the sense that as a game changer technology, we know that there's a before and after. But the misconception might be, the linear kind of thinking about growth and consumption and generally what we've seen in many, many bubbles is the fact that most companies invest as if they were the only guy. doing it, right? Not realizing that everybody else is their own chat GPT and whatever. So I think eventually this game, like the dot-com bubble in '01, will result in a flatter world. Will result in at that time, it was the internet and broadband that connected the world. And if you were an accountant in Bangalore, you could work for someone in California. That changed the world. I think today we're going through a dynamic where we're going to see a lot of solopreneurs, many one-man billion-dollar companies. I mean, this is where we're going. And what that means for other sectors, other companies, opportunities, there's going to be tremendous opportunities, but not necessarily where we're looking for them now. Some of them will appear and will continue to flourish. So I think back to portfolio construction, I think you've heard me many times talk about the sporting analogies now when we think about portfolio construction. And I think it's healthy to think about what you own as a team, and I'm Spanish, so I tend to use football or soccer more. But again, you could use any sport you like because they're all similar. But there's an offensive part of the game that looks to make money, both in capital and income gains. There are parts of the portfolio that look to protect both nominal and real and inflation adjusted. And so I call those guys upside alpha and downside alpha, those strikers and defenders. And every game, including investing, is a game of offense and defense, right? And what you don't want is to fall in the risk of false diversification. So to end up with a team of 11 strikers or 11 goalkeepers. And the problem with this is that a lot of people get fooled by looking at correlation, which is what really drives the behavior in terms of average correlations. That's kind of meaningless. What really matters is how do you behave under extreme circumstances? So we're looking at conditional correlation. How did you do in March 2020? And if your portfolio, every single asset in the portfolio fell in March 2020, then you're not diversified. You might think you're diversified because in normal conditions, some things go up and down, but you actually had 11 strikers. So it's very important to understand that these relationships, these correlations change, and they're very dynamic and they can be driven and impacted by many things. But certainly positioning, it's critical and other things. So when you think about portfolio construction, it's critical to create this team that will do well, can score goals, can defend, can pass the ball. And one of the areas that I've been doing a lot of work is precisely on that element of teamwork, portfolio teamwork. So, we have one. You could share some of the performance numbers, and I think that graph will show very clearly the composition of the team when you combine the upside alpha in the form of some sort of equity investment, downside alpha with the protection when it matters. And this year we had a big event in August, which was short-lived, but it left a few dead bodies in the river flowing down. And how you basically use those to take advantage of each other. How do you accumulate and monetize in a way that your team is always very balanced? So again, I keep going back to this idea of building solid teams with people and portions that do their job. They do it as a team, and you do it in a very unemotional, disciplined basis. But it takes quite a bit of art and science to figure out not only the what, but also the how much and when. And so that's kind of part of the work that we do in the strategies that we manage. We combine these assets into mandates such as protected rebalanced equity, which you might show on the screen. So that, I think, it's sort of the natural. How do you link this macro picture with the opportunity set in a framework that is all about behavior? It's not about labels. So when you hear about asset class, construction or diversification, the risk of equity down, fixed income down, which is the Achilles heels of the 60-40 balance portfolio and frankly, the global financial system, because I think that's when things really go wrong. If equities go down, but fixed income is there to protect you, like bonds go up, then in some ways you're okay. But the scenarios where inflation is really high, central banks need to respond with higher rates, that exposes some of the complacency in the market and what's been priced in, and equities suffer. You start to see that false diversification resulting in big drawdowns, and things start to implode and compound on themselves. So it's absolutely critical to find much more reliable reactive sources of protection, which is what we tend to do on a day-to-day basis. That's really the spirit of our business and what we try to do as the goalkeepers of the team. Right?
Yeah, and when those inverse correlations move toward positive correlations, you see exactly what I just described, this idea of false diversification, and it obviously is a challenge. Let me ask you this, as you talk about offense and defense, bubbles and anti-bubbles, which directions and which areas might we see in terms of sectors where we could see mispricing as a consequence of the AI revolution beginning to roll onto the table?
Well, fantastic question. And let's think through this. But, so in terms of, big to small, top down, traditional strikers have been equity and credit. So if you could buy Tesla stock or you could buy Tesla bonds, right? And in a low inflationary environment, they're both kind of doing their job. If things are working well and your underlying asset is holding and the payments are being made and there's growth, both score goals. The main difference between them is what it means from an inflation perspective. So one has a long inflation bias, the other one has a short inflation bias. On the defensive side, I would argue that fixed income or government bonds, that you could put things like gold or volatility or the VIX, S&P puts, a bunch of potential defenders. They all do it in potentially different ways. So I think those correlations are critical. Now, answering with respect to AI, I think probably we're starting a new phase in AI. So initially more about enablers than the big players. I think we're starting to see the rollout in more scale. That I think one of the areas that could benefit is the small caps, that rotation. And I'm by no means the expert on the equity side, but certainly I think that the impact of AI is going to go from big to small, all the way down to individuals and solopreneurs. So I think in that sense, the outcome is going to be fatal for a lot of people who cannot, do not, will not adjust. And I think the incumbents and the adopters and others are going to potentially take all that, including new players and small players that we haven't seen. So whilst the AI is a game changer, I think there's quite a lot of exuberance as well priced in, and a lot of linearity in expectations. But a question I keep asking myself, and I've been doing this for a while now, is if we were to draw the parallels with the .com, the assumption that we are going through a similar process, which I think we are we closer to 1997 or 2001 in some ways? But also, is this process, every technology has some sort of S-curve, right? So starts, becomes exponential, and then eventually flattens. We are seeing S-curves on top of S-curves on top of S-curves. So it's actually truly fascinating. I'm really spending a ton of time and learning a lot in this process. I'm really enjoying this ride, and I'm extremely bullish about the possibilities here for every single aspect. But it's very obvious as well that if you don't, if you're not careful, I think your business is at risk. So it's again, without going into much more detail in terms of region or sector or individuals, I think there is divergence, and is going to be a big driver of performance. You're going to see significant winners and losers in this process, and a lot of incumbents coming in. But again, if you would think about this bigger picture, I think, and we link it to the inflationary implications. Again, there's pretty strong two-way forces. I mean, think about the input for electricity prices and what it means. Think about what it means in terms of redundancy of jobs. Think about what it means for new opportunities. So I think it's still hard to tell exactly what the net impact is in terms of growth and productivity. Clearly, inflation and how that impacts the entire picture is probably, when I face this sort of dynamics with so much uncertainty and such strong forces in both directions, it's probably a sign that volatility, could be, it's probably on the cheaper side, and that's one of the higher convictions as well. I think you want to accumulate some of these things from a medium long-term perspective, because this is an extremely complacent market, and even if things go well, volatility can come in from good and bad reasons. So really a loaded question there, Ash, if I did justice.
Well, let me ask you this. When you talk about the risk of these fatalities, are there any particular areas where you see increased fragility or some of the hallmarks of what might be that fatality, as you say?
Well, for sure is happening in a number of sectors where, I think probably one of my favorite lines ever, and I was privileged to be in a conference with him, with Yuri Levin. He presented his book and I was next. It was very humbling. But he, for those who don't know him, is the founder of Waze, and he has a few unicorns. And his book is called Fall in Love with the Problem, Not the Solution. And it's an incredible book, a must read for both entrepreneurs as well as investors in entrepreneurs, which is what he's doing now. Fascinating guy, incredible book. And I think that's the idea. Those who fall in love with the problem will make it. And those who fall in love with their solution, they die. And that's how it works. So think about, for lack of a better, any in the film industry, right? Or like I'm thinking about cameras, or Kodak or Nokia, or they're effectively people who fell in love with the product and they forgot what they really do. And that probably links things a little bit with the energy market. I think the oil industry is falling in love with the product. They actually think that the world needs oil. Nobody needs oil. We need a cheap, reliable, clean source of energy to go, let's say, from point A to B, or to transform, X into Y. And so I think some of these industries that forget the real reason why they exist, and they forget that they are there to solve a problem or a need, and they focus, I think they will die. And more so in a world where things are happening, so fast, and your competition might come from areas that are completely, tangential or not expected. I mean, the gaming industry, I think, is a good example. Every investment you've made in CGI technology is now obsolete by a factor of 10 or 100 in terms of cost and whatever. So I'll defer to more educated people on the actual sectors and impacts. But I think the simple rule is, are you focused on the problem or your solution?
What a great book recommendation. By the way, extraordinary reviews on Amazon. I just bought the audiobook. I always am a sucker.
He's a superstar. He's a fantastic. It's very privileged to meet him, and he was very generous with his time. Spent a bunch of time together, and it's a very humble guy, and really, really amazing. The book was great as well.
What a fascinating way to tie all of this together in terms of this conversation. So many things that we've touched on here today. Diego, final thoughts, key takeaways that you'd like to leave our listeners and our viewers with.
Well, look, 2024 has been a truly incredible year. I think as we haven't really touched on politics and elections during the discussion, but there is turmoil. There's big changes. We barely talked about geopolitics or tariffs. There are truly major risks out there going into 2025. Some of which I think will effectively reinforce the ideas we discussed in the 50,000 feet view. If these get to materialize and effectively the political and geopolitical tensions and fragmentations and tariffs and other forms of actions are coming, I think they're going to result in are going to expose a bunch of complacent positioning. But I think, as always, try to avoid leverage as much as you can. That's sort of a highway to bankruptcy. I think a lot of the listeners are into areas that are doing very, very well. I would put some caution there, in terms of capital risk and leverage, and just make sure that you're in a position where you can embrace this volatility and position yourself for the very long term. But yeah, look, no magic wisdom. I think it's the world is perhaps more fragile than it looks. There are also reasons to be optimistic, and the next few years are going to be fascinating as we embrace these new technologies. But these dynamics are going to end up we're going to put us into a few dark sides as well. So I think when it comes down to the investment side of the discussion, which is where we are, I think people should definitely try to build these resilient portfolios that are truly diversified and don't fall in the trap of leverage or hidden leverage and false diversification. And to do that, I think you need to think forwards. You can't drive the car with the rear mirrors. The forward-looking picture may not be exactly what we've seen in the past, and that I think means that we're gonna need all the help that we can get, and hopefully these frameworks can be useful. If anybody wants to reach out and learn more about what we do on the protection side or the protected rebalanced equities, please do so. They can reach out through LinkedIn or X, Twitter. But yeah, it's
Diego, what's the name? What should they be searching for?
Parrilla Diego, Parrilla Diego, at Parrilla Diego. And yeah, most people miss the double R. That's all. Or Diego Parrilla. So it'd be a pleasure to connect, exchange, views, and see how we might be able to assist. So thank you.
Always a pleasure to have you with us, Diego. Always interesting to talk about these broad philosophical frameworks and some of the guideposts that people can use to start to understand and get their heads around what is happening in markets. Diego Parrilla, always a pleasure when you join us.
Thank you so much for having me, and all the best. Have a wonderful holiday season, and look forward to catching up again soon. Thank you.
And of course, one more time, please don't forget, tickets for our upcoming in-person crypto gathering are now on sale. Head over to realvision.com/CG2025. That's realvision.com/CG2025 to get yours. Thanks for watching. Thanks for listening. Have a great afternoon, everybody.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.